Hello, and welcome to Principles of Macroeconomics. This is Module 7.1, and today we will be discussing the balance of payments. The balance of payments are the measurements of economic activity that a country conducts internationally. It is comprised of two accounts, the current account and the capital account. The current account reflects the value of goods and services traded across countries, whereas the capital account reflects the monetary flows between countries for financial assets such as stocks, bonds, real estate, etc. The capital account and the current account balance each other out. In other words, if one is in surplus, then the other is in deficit. We will discuss this concept in much greater detail in the next video. Let's talk about the current account first. The current account comprises of net exports, net investment income, net transfers. The largest component of this is going to be net exports. So that's why when we think of the current account, we really think mostly of net exports. There are a number of factors that will determine the current account. The first is changes in relative growth rates or national income. If a domestic economy is growing more rapidly than its trading partners, then demand overall in that economy is rising. Therefore, all else equal, demand for imports will also rise. On the other hand, if foreign countries' growth is rising more rapidly, then demand for exports to those countries is going to rise. So our country's net exports will improve. Next, the changes in relative prices or in inflation. With higher domestic inflation, that is telling us that exports become relatively more expensive for foreigners, while imports become relatively less expensive. Therefore, with high domestic inflation, exports fall and imports rise. Next, changes in tastes and preferences. Here, the demand for traded goods is going to also impact net exports. For example, if country A's goods are perceived to be of poor quality, then the demand for those goods is going to fall. Exports from country A are therefore going to decrease. And lastly, changes in comparative advantage. If improvements in access to technology, improvements in human capital, or decreases in costs of production change, then comparative advantage may change, and there will be a change in net exports. Next, let's talk about the capital account. The capital account is based on financial flows, and specifically flows between interest-bearing assets. The most important determinant of the capital account will be the interest rate. The interest rate reflects the return on investments in a country. Investors are always chasing the highest return. Therefore, we will see changes in monetary flows and financial flows, and therefore the capital account, when we see changes in the interest rate, domestically versus abroad. So what have we learned in this segment? Well, we've learned about what the balance of payment is, what it comprises of, the current account and the capital account, and what is part of each of those accounts. The current account is comprised mainly of net exports, and the capital account is mainly comprised of financial flows, or what we call net capital flows. In the next video, we'll go into much greater detail of the relationship between net exports and net capital flows. Thanks so much for joining me in Module 7.1.